Hi, I am Og John Ag, yesterday morning, at approximately 9:30 a.m. Shanghai time, the world's largest physical silver market reopened after 8 full trading days of silence, 8 days of thin liquidity, 8 days of paper games, 8 days of Western algorithms pushing silver around like a chess piece with no king on the other side of the board. And when China came back, when the Shanghai Gold Exchange turned its lights back on for the first time since February 16th, the very first thing the Chinese market did was not panic sell the rally. It was not dump exposure from the holiday. It was not validate the bearish narrative that the paper traders had been constructing all week while Asia slept. The very first thing China did when it came back was bid. And now we are 48 hours away from the most important single date on the silver calendar in 2026, Friday, February 27th, first notice day for March COMEX deliveries. The moment every video on this channel has been building toward since January. The moment where the math either breaks the paper market or the paper market finds a way to survive one more time. And I am going to walk you through exactly what China's return means, exactly what the inventory numbers are telling us right now today, on February 25th, exactly why the next 48 hours could determine whether silver goes to 95 or back to 72. And I'm going to show you the one signal buried inside Tuesday's COMEX Vault report that nobody in mainstream financial media is talking about, because they don't understand it, or they don't want you to understand it. Either way, you're going to understand it after this video. Looking at the numbers, roughly 75% of you watching right now are not subscribed. If this kind of real-time, data-driven analysis, the kind that does not wait for headlines and does not manufacture narratives after the fact, the kind that gives you the framework to think clearly before the move happens and not after, if that is valuable to you, hit subscribe right now and drop OG John AG in the comments. That is how I know this community is locked in and ready for what is about to happen. If it is not for you, no hard feelings. I am not here for vanity metrics. I am here for the people who want the truth, not the version of the truth that gets packaged neatly for retail investors after the institutional money has already made its move. Let me start with China, because China's return to the market yesterday is not just a footnote. It is the central story of what happens on Friday. When Shanghai opened Monday, February 24th, the opening price on the Shanghai Gold Exchange came in at a premium above London spot that told you everything you needed to know about how 8 days of Lunar New Year had affected physical demand in the world's largest consuming nation. The premium did not compress. It did not collapse. It widened. Shanghai silver was trading approximately 12 to 14% above Western spot on the reopening session. That is not the behavior of a market that used its holiday to reconsider whether silver is overvalued. That is not the behavior of a market that sat in Lunar New Year celebrations and came to the conclusion that $79 silver is expensive and they should be selling it. That is a market that spent 8 days unable to buy, watching paper prices drift in thin liquidity, and the moment the gates opened, it paid the premium to get metal because it needed the metal and it could not wait any longer. And understand what that means in context. We just watched silver trade in a range between 77 and 82 for 8 straight days without China. The paper market held. The bulls and the bears fought to a draw in the thinnest liquidity conditions of the year. Flash crash did not materialize. The doomsday scenario many were pricing in for the holiday week did not materialize. And then China came back and immediately bid up the premium. That is the first signal. Now let me give you the second signal, and this one is going to stop you cold if you understand what you are looking at. COMEX registered silver inventory. This is the number I have been tracking daily since October, when it sat at 167.7 million ounces. Let me walk you through the journey. October 2025, 167.7 million ounces registered. December 2025, approximately 140 million ounces. January 15th, 2026, approximately 127 million ounces. February 1st, approximately 110 million ounces. February 14th, we crossed below 100 million ounces for the first time in the modern era of this crisis. And as of Tuesday, February 24th's Vault report, which updated at 9:30 p.m. Eastern last night, COMEX registered silver inventory sits at approximately 91.4 million ounces. 91.4 million ounces. That is down from 167.7 million ounces in October. That is a decline of 76.3 million ounces in 4 months. That is a 45.5% drain in registered inventory in 120 days. And here is where the numbers go from alarming to terrifying. March open interest as of Tuesday's COT update represents approximately 286 million ounces of theoretical delivery obligation. Now yes, A large portion of open interest rolled during the Lunar New Year week. We watched open interest compress from 455 million ounces 2 weeks ago down to approximately 286 million ounces today, as speculative traders rolled their positions forward into May and July contracts. That rolling is normal. That rolling happens every delivery cycle. But here is what is not normal: the contracts that did not roll, the contracts that remained open into first notice day, the contracts being held by people who want physical metal and are willing to go through the delivery process to get it. That number, the contracts that are staying put and demanding delivery this Friday, represents the key to everything. If even 15% of the remaining 286 million ounces of March open interest stands for delivery, you are looking at 42.9 million ounces of demanded silver against 91.4 million ounces of registered inventory. COMEX delivers, barely. If 25% stands for delivery, you are looking at 71.5 million ounces demanded. COMEX is under severe stress and will drain below 20 million ounces of registered inventory before March ends. If 35% stands for delivery, you are looking at 100.1 million ounces demanded against 91.4 million ounces available. COMEX cannot deliver in full. The system breaks. And February's delivery data is telling us which of those scenarios is most probable. Because February did not deliver at the historical 2 to 5% rate, February delivered at a rate we have never seen in peacetime commodity markets. As of the latest data, February settled 19.2 million ounces against 19.6 million ounces of original open interest. That is a 98% physical delivery rate, not 5%, not 10%, 98. That means only 2% of February contract holders accepted cash settlement or rolled their positions. 98% said, "Give me the metal," and the metal was delivered because February was a smaller delivery month. But March is the real delivery month. March is historically one of the largest delivery windows of the year, and March open interest, even after the rolling, still represents 286 million ounces. If March follows February's 98% delivery pattern, you are looking at 280 million ounces of silver demanded from a registered inventory of 91.4 million ounces. That math does not work. That math does not work at any price. That math does not work whether silver is at 80 or 800. You cannot deliver 280 million ounces from a vault holding 91.4 million ounces. You cannot create 188.6 million ounces of physical silver by raising or lowering the margin requirement. You cannot solve a physical shortage with a paper adjustment. That is the scenario the market is pricing on Friday. And nobody is talking about it because it is too uncomfortable to confront directly. But I am going to confront it directly because that is what this channel does. Now let me address the counter-argument because I always give you both sides. Because if you only hear the bullish case from me, you are not getting the full picture and you deserve the full picture. The bearish counter-argument goes like this. Open interest compresses dramatically in the final days before first notice. Speculative longs that want delivery have already been rolling out or squaring up since mid-February. The smart money that planned to stand for delivery has been positioning for weeks and will not create a surprise on Friday. The 98% February delivery rate was an anomaly driven by specific institutional positioning and will not be replicated at scale in March. COMEX can always cash settle contracts at a premium to avoid default. JP Morgan, which controls the delivery mechanism, has access to metal sourced from outside the registered category. The eligible category currently holds approximately 350 million ounces of silver at COMEX vaults. That silver is owned by institutional investors, ETF custodians, and private holders who could, under the right conditions, transfer metal into the registered category to meet delivery demand. That is the bearish case. And it is not nothing. The eligible category is real. The ability to cash settle is real. JP Morgan's market dominance is real. I do not dismiss any of that. But here is why the bearish case has a crack running through it, the size of the San Andreas Fault. The eligible category holders have been watching COMEX drain for 4 months. They have been watching registered inventory fall 45%. They have been watching delivery rates at 98%. And if they were willing to transfer eligible silver into registered, they would have done it already. They would have done it in January when the crisis started. They would have done it in February when delivery rates went parabolic. The fact that eligible metal is sitting at 350 million ounces, while registered drains from 167 to 91 million ounces, tells you exactly what eligible holders think about handing their metal over to the delivery system at current prices. They are not doing it. Not yet. Not at 80, maybe at 120, maybe at 150, but not at 80. And as for cash settlement, yes, COMEX can cash settle contracts, but cash settlement at what price? If you are a fund that planned to stand for delivery in March because you need physical silver for industrial use or for allocated storage, and COMEX comes to you and says, we cannot deliver your 5,000 ounces per contract, we will cash settle you instead, what do? You take the cash settlement, and then you go buy physical silver on the open market at whatever price it is trading at. And that buying, that forced buying from cash-settled longs who still need their metal, creates a secondary demand wave that drives the spot price higher and makes the next delivery cycle even more expensive to settle. Cash settlement does not end the squeeze. It defers and amplifies it. That is the structural reality that nobody in mainstream finance wants to say out loud. Now let me tell you what happened in Tuesday's COMEX Vault report that is not getting any attention, because this is the buried signal I mentioned at the beginning. On Monday, February 24th, the day China reopened, COMEX Vault activity showed something that should make every person watching this video delivery-eligible registered category on the exact day the world's largest physical buyer comes back from holiday. You are watching the invisible handwork in broad daylight. Where did that metal go? We cannot know for certain, but the most logical answer, given the Shanghai premium, given the scale, given the timing, is that metal is moving east. Metal is being removed from the COMEX system and delivered into the physical pipeline that feeds Asian demand at premium prices. And that means the 91.4 million ounce registered figure I showed you earlier is going to be lower by Thursday when we get the next vault update. We could be looking at 85 to 87 million ounces of registered silver at COMEX when first notice day hits Friday. Let that land for a moment. 85 to 87 million ounces available. 286 million ounces of open interest. Even at a 25% delivery rate, the system is tapped. Even at 20%, the remaining inventory after March delivery would leave nothing for April, nothing for May, nothing for the ongoing industrial delivery mechanism that feeds the solar panel manufacturers, the semiconductor plants, the defense contractors, the EV charging infrastructure that is being built at record pace globally right now. Now let me bring this back to the price because numbers matter, but what you actually do matters more. Silver is trading at approximately $80 to $81 as of Tuesday afternoon. Gold is holding above 5,050. The gold to silver ratio is sitting at approximately 62 to 1. At the January peak, that ratio touched 30 to 1. The mathematical compression trade, the simple arithmetic of what happens if gold stays at 5,050 and the ratio normalizes back to even 50 to 1, puts silver at $101. If the ratio compresses to 40 to 1, silver is at 126. If the ratio goes back to the January peak of 30 to 1, silver is at $168. Now, I am not giving you price targets. I do not do price targets. I do math. And the math says the gold to silver ratio is stretched to a level that has historically been temporary in every single precious metals bull market in history. In 2010 to 2011, the ratio touched 68 to 1 at the nadir of silver's underperformance, then compressed to 32 to 1 at silver's peak. In 1979 to 1980, the ratio went from 38 to 1 all the way down to 15 to 1 at the height of the Hunt Brothers episode. In every meaningful silver bull market in modern history, the ratio has compressed dramatically. We are at 62 to 1 today with first notice day 48 hours away, with China backbidding a 12 to 14% premium, with registered inventory at 91 and falling, with February settling at 98% physical. The ratio compression trade is still wide open, the boat has not left, but the dock is getting shorter every day. Now, there is one more piece of this puzzle that I want to address because it changes the risk calculation for everyone watching, whether you hold physical, whether you trade futures, whether you own mining stocks. The Federal Reserve, because the Fed is still in this picture. Jerome Powell is testifying before the Senate Banking Committee this week. His words on rate cuts, on the economy, on inflation trajectory will move the dollar and they will move precious metals. And here is the macro setup he is walking into. January inflation came in at 2.4% headline, the lowest since May 2025. The labor market is showing cracks. ADP payrolls printed 22,000 in February versus 150,000 expected. Jobless claims are trending higher. GDP growth is slowing. Every single macro indicator is pointing in the same direction, which is toward a Fed that needs to cut rates, not because inflation is solved, but because the economy is weakening faster than inflation is cooling. And in that environment, in a world where the Fed is being pushed toward easier policy by economic reality, where the dollar is already down 9% year over year, where real yields on 10-year tips are sitting at 1.86 and falling, where gold is above $5,000 and institutional targets are $5,400 to $6,300, silver has every macro wind at its back. The CPI came in soft, the labor market is softening, the dollar is structurally weak, rate cuts are being priced back in. That is the same combination that sent silver rocketing 7% in 4 hours 2 Fridays ago. And now on top of that macro tailwind, you have China back, bidding the market after 8 days. You have first notice day 48 hours away. You have registered inventory below 92 million ounces and falling. And you have a 98% physical delivery rate from February, telling you that the people who are staying in these contracts want metal, not cash. Here is my assessment for the next 48 hours and beyond. Between now and Friday morning, I expect open interest to continue declining as late rollers move out of March. That is normal. That happens every cycle. Some funds will take cash settlement over the uncertainty of the physical delivery process. That is expected. But the funds that are staying, the funds that have held through the January crash, through the 6 CME margin hikes, through the Lunar New Year liquidity drain, through JP Morgan's vault activity, and all of the volatility that comes with this market, those funds have made a decision. They are not rolling. They want the metal. And those are the entities that are going to determine whether Friday is the day the paper market cracks or the day it survives one more time. I do not know which one it will be. Nobody does. And anyone who tells you they know with certainty is lying to you. What I know is the math. 91 million ounces registered, 286 million ounces of open interest. February delivery at 98%. JP Morgan removing 4.2 million ounces of registered silver on China's first day back. Shanghai premium at 12 to 14%. Silver in backwardation. Lease rates at levels that have not been seen in decades. Industrial demand running at record pace. The Silver Institute forecasting the 6th consecutive year of supply deficit in 2026. Physical premiums on Silver Eagles at 22 to 110% above spot. The U.S. Mint still not releasing 2026 Silver Eagles into normal retail channels. Dealers reporting 8 to 10 week delivery windows. All of that existing simultaneously with a paper market that shows silver at $80 while the physical market screams shortage at every level. Something is going to give. I cannot tell you the exact hour or the exact price. I can tell you the direction the data is pointing, and it has been pointing the same direction for 4 months now. And for the long-term stackers who make up the core of this community, listen carefully. If silver pulls back before Friday because open interest rolls down faster than expected and the immediate delivery pressure relieves, that is not the end of the story. That is the next buying opportunity. Because the 6th consecutive year of supply deficit does not end, because March delivery was managed. The drain in COMEX registered does not reverse because JP Morgan found 20 million ounces to plug the gap temporarily. China's demand does not evaporate because the holiday is over. The structural case for silver is not a 1-month story. It is not a first notice day story. It is a 5 to 10-year story about a world that needs more silver than the mines can produce. In an era of renewable energy transition and electrification, at a moment when the global monetary system is under the most stress it has faced since the 1970s. That story does not resolve itself in 48 hours. What resolves in 48 hours is one chapter of that story. And whether that chapter ends with a COMEX squeeze or a managed roll, the next chapter is already being written in the vault data, in the Shanghai premiums, in the lease rates, in the delivery rates, and in the balance sheet of every central bank on Earth that is moving away from dollars and into metal. The OG community has been watching this build since October. We have tracked every vault report, we have documented every delivery notice, we have followed the JP Morgan positioning data. We have watched China's premium and Shanghai's warehouse inventories. We have been here for every margin hike and every manufactured crash. This community did not panic in January. This community did not panic during Lunar New Year. And this community is not going to panic now with 48 hours to go, because panic is what weak-hands do. Patience is what smart money does. And the physical market, the real market, the market that moves actual metal from vault to industrial user to central bank reserve, the physical market has not flinched once in 4 months of paper games. Not once. Premium held. Delivery demand held. Backwardation held. Shanghai held. The physical market is not blinking. That is the most important signal of all. 2 days to Friday, 91 million ounces of registered silver, 286 million ounces of open interest. China backbidding 12% premium after 8 days of silence. JP Morgan removing 4.2 million ounces from registered on day 1 of China's return. February delivery rate at 98% physical. The trap is set. Friday is the trigger. Watch the open interest final figure Thursday night. Watch the registered vault report Thursday at 9:30 p.m. Eastern. Watch the first delivery notices that post Friday morning before the U.S. market opens. Those 3 data points will tell you everything you need to know about whether this is the moment or the moment is being deferred to April. Either way, you are already positioned. Either way, you understand the math. Either way, you are not making decisions based on emotion or headlines. You are making decisions based on data, and the data has been consistent for 4 months. Do your own due diligence. Understand the risks. Silver is the most volatile major asset on the planet. 30% crashes happen here. 22% overnight crashes happen here. That is the price of admission for an asset that can also triple in 12 months. If you cannot tolerate the volatility, you should not be in this market. But if you can, if you have done the work, if you understand the structure, if you know what registered inventory means and what backwardation signals and what a 98% delivery rate implies, then you know what the next 48 hours represent. Physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. OG out.